How to get pre-approved for a loan. But before we get started, make sure you hit subscribe down below, hit the like notification. If you do like the video, hit the bell notification so each week you get notified every single time I share my knowledge of how to buy and sell real estate in the Bay Area. So with that being said, let's get started. Not having a pre-approval is like going to the mall without your wallet. But in all seriousness, getting pre-approved is the first and possibly one of the most important steps of the whole buying process. Without getting pre-approved, you're not gonna know what you can realistically afford up to, and also you might be able to afford more than you actually thought possible. And in the Bay Area, I just want to stress that we are in a very competitive market. So if you submit an offer without a pre-approval, more often than not, the seller and the listing agent will not even look at the offer if there is not a pre-approval letter in that offer. With that being said, after you watch this video, you're gonna know the whole process of getting pre-approved. So let's get started. When getting pre-approved, it's always recommended that your realtor refers you to at least 3 lenders so you can shop around who can get you the best interest rate, the best programs, and the best payment that you are comfortable paying each month, which is going to include your mortgage, your taxes, your insurance, your mortgage insurance if you did decide to put less than 20%. And after you find a lender that you want to work with, they are going to ask you for a lot of documents. You will need 60 days of your bank statements, your most recent pay stubs, 2 years worth of W-2s, outside account statements such as your stocks, mutual bonds, and retirement savings, your US passport or driver's license. And if you are going to be receiving down payment assistance from your relative, also a gift letter explaining where that down payment is coming from. The 3 factors that affect your pre-approval are your debt to income ratio, your credit and FICO score, and your income and employment history. So let's get started with your debt to income ratio. Your debt to income ratio measures all of your monthly debt relative to your monthly income. Your lender will add up all of your monthly debt, such as your credit cards, your car loans, your student loans, revolving lines of credit, and plus also your new mortgage payment. Then they'll divide it by your gross monthly income to get you your debt to income percentage. Depending on what loan you decide to go with, you should make sure that you maintain a debt to income ratio at or below 43% to qualify for a mortgage. But what I recommend is to aim lower than 43% so you can get the best rate and the best loan possible. And before you decide to buy a house, make sure you pay down as much debt as possible. You don't want to add more debt onto your plate. So if you do have, let's say, student loans that you need to pay off, pay much of those loans off as much as possible. If you have a car loan, for example, make sure you pay that off as much as possible as well. It's never a good idea to add on more debt to your plate because you're going to be owing a lot more money and own a lot more interest. Next up is credit history and FICO score. Ideally, you want to make sure that your credit score is a 660 or higher to get the best rate possible. Your lender will also look at your payment history and your bills to make sure that you are paying everything on time, and also they're going to look to see what accounts you have open and how long you had those accounts open for. Also, you want to make sure that your credit utilization rate is 30% or lower to get the best rate possible. And last up is income and employment history. Typically, your lender will ask you for 2 years worth of W-2s. They want to make sure that you can handle the added financial burden of a new mortgage. Your lender will also ask you for your salary information so they know you earn enough to pay for your mortgage and also the monthly costs associated with being a brand new homeowner. And that is how you get pre-approved for a loan. I hope this video brought you tremendous value. If it did, please like the video, comment down below any questions that you have, share this video with your friends, family members, and colleagues. Thanks so much for watching the video. I'll see you in the next video. Take care, peace.